Hi everyone, Joe Gentili from Left Tail Risk Advisors. In this video, I want to go through what I feel is one of the most underrated or underappreciated aspects of life insurance and success with life insurance planning, and that's the need for ongoing policy reviews. So, for all types of life insurance, having policy reviews on a periodic basis, whether it be a year, and depending on the type of policy, more or less frequently, but having periodic policy reviews is very important for all types of life insurance. You need to check and see that if you have certain goals in mind with the policy in terms of cash value growth or death benefit growth, you want to see that the policy where it stands in terms of those goals, if it's progressing well, if it's performing too well, you don't need quite this much death benefit, or it's not performing well enough that you need to supplement or increase that somehow. You want to see if the goals for the life insurance policy are still in place, whether the planning need that at the time looked permanent is no longer needed. So you may want to repurpose those assets in a particular way. So that's for all types of life insurance. And also you want to see if you have a what looked like a temporary need that's becoming a permanent need, where you may want to convert some term life insurance into permanent. Some types or say some categories of life insurance require more maintenance than others. And again, I keep going back to this, but to me, life insurance exists on this risk spectrum from conservative to, let's say, risk forward. On the conservative side of the spectrum is whole life insurance. And whole life insurance has guarantees in it that are very valuable. And the one that comes to mind in this scenario is a guaranteed level premium. So it's pretty simple to keep a whole life insurance policy in force, especially if there's no policy loans involved. You pay the premium, the policy stays in force, period, end of story. Very simple. Other types of life insurance, as you move further down that spectrum, once you get into the universal life chassis, that becomes more complicated. It's not as simple with a universal life insurance policy, whether it's a straight UL, an IUL, or a VUL, that you pay the premium and the policy stays in force. That's not true. This is one of the areas where that's a little unique with life insurance versus other types of insurance. So for other types of insurance, premium is synonymous with cost of insurance. When you insure your car, the cost of insurance of insuring your car is the premium that you pay. That's not really true with life insurance, and especially universal life insurance. Your premium is the amount of funding that you're putting into the policy from which cost of insurance is taken out. So let's say that initially your policy was forecasted to have a 6% return annually, and you were given a funding amount in order to keep the life insurance policy in force for life, assuming that you're getting that 6% return. Well, that's just an assumption. That is not a guarantee. So if your policy, it turns out, is averaging less than 6%, or it's averaging 6%, but the sequence of returns are not in your favor. In other words, some years it's 7, some years it's 5, and that sequence doesn't work out to the way the policy is illustrated. Very easy for the policy to end up underfunded. And that's a problem because unlike the level premium that a whole life insurance policy has, universal life insurance policy generally works as adjustable renewable term for life. So every year the cost of insurance is priced as if what it costs to insure a person at your given age. So at 40, cost of insurance is very cheap. At 80, very expensive to insure an 80-year-old, and it goes up every single year. And the idea with universal life is that if you fund the policy properly, then the cash value is going to increase at a faster pace than the cost of insurance, and therefore the policy stays in force. That needs to be monitored to see if it's actually happening. If that is caught late in the process, if nobody's monitoring the policy and you figure out at age 70 after you're retired that the cash value is not throwing off enough return and there's not enough cash value to keep the policy in force for life, the amount of money that you have to fund a policy at that point is going to be very, very expensive. And it puts people in a very uncomfortable position where many of them unfortunately choose to lapse the policy after a lifetime of payments. Problems with life insurance, I've heard it described like when a star explodes. So the event happens, but you don't see the impact of it for a long time. So a lot of times if you have somebody that's well versed in life insurance, say you got that policy at 40, if you see early on, 43, 45, that the cash value is not on pace for where it can go, you can see that this is going to be a problem over the long haul. And that instead, if you look at an in-force illustration, for instance, you may see that instead of the policy looking like it's going to stay in force indefinitely or well into old age, it could end up lapsing or be forecasted for a lapse during your lifetime or during your anticipated normal lifetime. And if you catch that problem at 45, the funding you need to address that is a lot less than if you catch it later on. So it's very important to have somebody monitoring the policies. This is even more so when you have policy loans involved, and it's even more so if you have variable policies, because what can happen with variable policies is that in that example I gave with universal life insurance or index universal life insurance, where your funding is if you're going to get a 6% return, but you actually end up getting a 4%. Well, with variable universal life, maybe your funding is if you're going to get an 8% return, but your returns turn out to be negative because of market losses. You're susceptible to market losses depending on how you invest with a variable universal life insurance policy. So not only does the cash value go down and it's not accumulating enough to offset the cost of insurance, you now need more insurance to keep the same death benefit. Because the way life insurance works is you have your cash value and then you have your death benefit. And what you're paying insurance on is the difference between the two. So if I have $300,000 of cash value and I have $1 million death benefit policy, then I'm buying $700,000 worth of insurance. I have a variable universal life insurance policy and there's a big market setback. I go from having $300,000 in cash value to $200,000 in cash value. Not only is the cost of insurance per dollar of insurance going up because I'm getting older, but now I need more insurance because the difference between my cash value and death benefit is now $800,000 instead of $700,000. So that is a compounding problem. And these are not the type of policies that are set it and forget it. I think that's true for all types of life insurance, but as you go further down that spectrum, it becomes more important. So if you already own a life insurance policy, regardless of the type, I strongly suggest that you get periodic policy reviews. And if you have a whole life insurance policy, you're going to want to review it, not so much for premium sufficiency to make sure that the policy stays in force if you pay the premium, that's guaranteed. You want to review it to make sure that you have appropriate amounts of insurance and that the insurance is still serving the purpose that you have. Same thing with term life insurance. You want to review it to make sure you have appropriate amounts and if it's still serving the correct purpose. But as you get towards the more risky ends of life insurance, the universal life chassis, straight universal life or index universal life or VUL, you need to now include premium sufficiency into this analysis to make sure that the policy is properly funded to not lapse and to not get caught with the potential lapse late in life when it's very, very expensive to make up and when you're probably not working, so income is tighter. So I would suggest that you have it reviewed either by the agent that wrote the policy for you if they're not available or they're no longer you no longer want them to do the review for some reason. For most people, it's going to be worthwhile to pay somebody a flat fee or an hourly fee to take a little bit of time to review the policy and make sure that it's going in the right direction and that it's not destined for a lapse. Those small amounts of money that you're paying for somebody to review the policy can, especially if you're dealing with policies that have, mid six figures, 7, 8 figure death benefits, very, very much worthwhile to make sure that those policies are performing as needed in order not to lapse. So that's what I have to say on this topic. If you want to discuss or you have a policy you'd like us to review, please feel free to reach out. If not, I encourage you to subscribe for future videos as we're doing a lot more on life insurance related topics. Thanks. Have a great day.